Okay, for chapter 4, we are looking at completing our financial reports for our company. This company is departmentalized, and so really you'll just see the account names divided up into the different departments. So as we get to the end of a fiscal year, fiscal period, we need to ensure that all the transactions have been journalized. Then all of those journals have been posted. And then perform any bank reconciliations. We want to check our subsidiary ledgers for accounts payable and accounts receivable and make sure they match up with the general ledger for accounts payable and accounts receivable. And then once everything has been put into journalized and posted, and so we've got our ledgers up to date to that point, then we need to create an unadjusted trial balance. Okay, and so basically what we're doing is we're taking, this is kind of the beginning of a worksheet, taking all of the accounts, so every account that's in the chart of accounts should be listed, and then we go through the ledgers and we pull those balances from the ledgers. And when we finish, our debits should equal our credits. And that's a good check for us as well, is to go through this process just to make sure debits equal credits for every ledger, which means every journal and so on. Okay? Then we need to update some other accounts that don't, before we end the year, basically. And so we're going to do adjustments. These are the basic adjustments that we will look at in this chapter for uncollectibles, merchandise, supplies, prepaid insurance, and depreciation expense. And so this is one of the reasons we skipped this chapter, is because I want to go ahead and have you go and understand what uncollectible accounts are and merchandise inventory and the different ways to take inventory and depreciation. So we skip this, we go through those chapters, and then I like to come back because you have the numbers here, but they might mean a little bit more to you. At least that's kind of the hope. Okay? So we'll do adjusting entries in our general journal. Before we go straight to our journal, though, I really want to kind of walk through it in this notes page that I have for you as well. We're still going to use the numbers from the Working Together for 4.1. So it's page 107 for looking at that. And really what we're going to come down here and do is the calculations for our adjustments. So the first one, if you look in your book, it tells you that there's an estimate of uncollectible accounts. Okay? And that's what we're doing first. We're recording the adjustment entries on page 20, and these are the numbers that we have so far. Okay, so the estimate of uncollectible. So we did a percent of accounts receivable or a percent of sales, whatever method we did, and we came up that this is the number that our account should be at, our allowance for uncollectibles should be at. Okay, so you may have to calculate this if there's still a balance from the previous year. Well, in our case, there is, and we know that because in our ledger, our general ledger, the balance on December 31st is $77.38. So we need our new balance to be 2101. So what's the adjustment that we need to make? We don't need to add the entire 2101. We just need to add enough to get it to 2101. If you can remember that from that chapter. Okay? So on your notes here, I give you that information. The current ledger balance is $77.38. Okay? Again, this comes from the ledger. And it was a credit balance. Okay? And then the new estimate, the estimate that we're going to use, which came from the book, is the 2101.23. Okay? So if we were to make these T's, here's our current balance, okay, and we need this to be end up at 2101. So we're going to add, so we'll need to actually do math. 2101.23 minus 77.38. All right, so I know that this number, we need to add this amount to this number to get the 2101. Okay, so there's my credit. The expense will come over here. Okay, and so like I said again, if you want to add that up, okay, and that's where that number comes from. All right, then we're going to jump over to our general ledger and record that. So for adjusting entries, on December 31st, our uncollectible accounts expense has our debit of 2023.85. Oh, I always forget that. Page 20, I think, right? And then the allowance for uncollectible accounts $2,023.85. Okay, so really we can put a note over here. For this one, we have a beginning and we have an ending. Okay, 7738 was our beginning balance. 2101.23 is our ending balance. So the difference between those two is your adjustment. Another way to look at it, that might be a little bit easier for you than the T's, or all of it together. Hopefully, will be helpful. All right, so there's that adjusting entry. Then next is merchandise inventory. Okay, so back to our book. We have, this is departmentalized, so we have inventory for the kitchen and inventory for the bath departments. Again, remember this is ending inventory, and we're trying to figure out what the difference is. How did it change? That's the adjustment that has to be made. So if we have our ending, what's our beginning? Where do we go find our beginning? Okay, we find our beginning in the ledger. Okay, merchandise inventory doesn't get touched. We don't add, we don't journalize, we don't post into it throughout the year. Okay, we only update this with adjustments. All right, because this is the physical count. This is the periodic count. When we actually purchase our merchandise, that goes into purchases, and that's where we keep track of it as we purchase it. Okay, but these counts are only touched when we make adjustments. So we know that this is the beginning inventory, even though it says December 31st, okay, that was actually the same thing as January 1st because this never got touched. So this really is our beginning inventory. Okay, and then this is our ending inventory. So that's where those numbers are coming from. All right, so you can see here, the 140890 came from the ledger. The 147084 came from the book. Okay, this is an increase in inventory. Okay, beginning, ending. What's the difference? If we do the math, the difference is 6194.62. Okay, and so what we need to know is basically, do we put it in as a debit or credit? And when we increase merchandise inventory, it's going to go in as a debit. Okay, now, again, this is an adjusting entry. Okay, so we don't have a corresponding account to go along with merchandise inventory, but we have to have a credit. So we're going to put it into income summary. Or this could be departmentalized too. I think it may be on the financial statements. So 6194.62. Okay, here we've got a decrease. Here is the beginning inventory. Here's the ending inventory. The difference is 948. This is kitchen. This is bath. 948.69. Okay, so if it's a decrease, it's going to go to the credit side. And the increase decrease is just depending on, I mean, we bought product all year long and we sold product all year long. So it's just the timing of how that ends up, whether we increase or decrease. There's nothing good or bad about it. Okay, it's just the timing of how our purchases came in and how our sales went out. Okay, and then of course we need income summary to be the debit part of that transaction. Okay, so there's the adjustment for that. So we will go back to our adjusting entries. Okay, again on the 31st, for merchandise inventory, for kitchen, we had 6194 as a debit. And then income summary, and we are going to go ahead and keep this departmentalized. So we're going to have a separate account for each of these. Okay, and so we had a beginning and an ending. 140, 890, and the ending was 147, 084.62. Okay, so this was an increase. That's what it looks like when we increase it. And then we'll do the bath. Oh wait, debit first. So because this one has the income summary as the debit, we need to do it first. And we will break it down to the bath. 94869. And then merchandise inventory for bath. 94869. Okay, and again, the beginning, your ending, 98620 and 97671. .31. Okay, and this one is decreasing inventory. Okay. Our next adjustment is supplies. So this is supplies on hand. So as we buy supplies, we put them in the cabinet, we put them in the cabinet, we put them in the cabinet. But at some point, we've got to record the fact that we used up some supplies. So by looking at the balance in our ledger, we can see what we started with, what we're ending with. Supplies on hand is just like ending, and the difference between that is what we used up, and that's our adjustment. Okay. So, let's see. Again, going to our ledger, this just gets, let's see, our ending balance 609789. So we may have put all the supplies in, all the supplies in, all the supplies in that we needed to. And this is where we're sitting, 6097. Balance in your ledger. On hand on the 31st is 1950. That comes from the book. Used up during the year. Subtract those two, which is the adjustment, 414789. So we used that much up during the year. So we need to decrease our supplies by that much because we don't have it. It's not an asset to us because we don't have it anymore. And we're going to use that expense account. Okay, that was the expense we spent on supplies. Okay, and then we'll record that in the general journal. So our debit first, supplies expense. And supplies. 4147. Oh goodness. Okay. And then we again we have the beginning and ending, or at least balance and a amount on hand. I don't know if this is necessarily beginning, ending. That might not be good terminology, but you get the idea. I think it'll help. Think about it this way. Okay, and so the difference between those two is your adjustment. Okay, next one, insurance expense. Okay, balance in the ledger, 18,000. Okay, unexpired insurance on December 31st from the book. Value of prepaid insurance. Unexpired, value of the insurance currently, kind of same terminology, different words. Again, the difference between the two is what's been used up. So the difference between those two is 15,500. We'll make T's out of these again. We've got to reduce our insurance by that amount and make sure that we record it as an expense. Okay, so there's our debit, there's our credit. Going back to our adjustments. $15,500. And reducing the value of our prepaid insurance by that amount. Again, kind of thinking we've got a beginning balance and an ending balance. The difference between the two is our adjustment. Okay? And then the next two are depreciation expense. Okay? And these numbers have been kept up with. Okay, you've just finished the chapter where you have been recording depreciation. And so these will be actual numbers. Okay, we don't need to do any extra there's not a beginning inventory or beginning and ending numbers. So these we just record. Okay. Let's see, do I have anything special here in your notes? All right, so depreciation expense, we're expensing the value of the asset over time. From the book, it gives you the number 7250. Like I said, for our purposes, it's usually given, not calculated. Okay, and then the corresponding account to depreciation expense is accumulated depreciation, which is our contra asset. Remember, this is a contra asset. Okay, and what is our number? Again, 72, and this is for office equipment. This one will be the office. 7250. Okay, and then we'll also do one for store equipment, but same thing, it's given to you. Okay, so now we'll do the adjustment for that. On the 31st, depreciation expense. Our department is office equipment. $7,250. And accumulated depreciation, office equipment. And then same thing for our store equipment. And that amount is 8490. Again, given to you in the book. Okay. And accumulated depreciation. Store equipment. 8490. Okay, and these were actual numbers. Okay, so there's one more. Let's see, record the adjusting entries. We've done that. Step 2 is to post into the general ledger. So we would need to go through all of the posting of these back into our general ledgers, and then enter those balances onto the adjusted trial balance. So you need to go ahead and stop at this point, and you need to post those numbers. I'm going to try to use my answer key to show you those numbers so I can continue on with the video. But again, you need to stop. You need to post these into your ledger, get the new balances, the updated balances. Okay, and so then you should have your post reference numbers here, and this column should be full. Okay, I'm not going to do that right now, so mine's going to be blank, even though that's not actually correct. All right. Once you post, so now you're coming back to this video, I hope, after you've posted. Let me get the right page out. Okay, so once you post, it says to enter the adjusted account balances on the adjusted trial balance. So you have a page for the adjusted trial balances that has these blanks in here. So they put all the other numbers in for you. We just have to put in these new numbers for that account for the adjustments. Okay, so the allowance for uncollectible accounts, go to your ledger. Okay, and I also have some notes here. Remember, this is the actual adjustment, okay, and these are the balances. This is what we calculated. This is what came from the book. Okay, just again so you know where those numbers came from. So we're looking for the new balance, 2101.23. Okay, and it's a credit here, so it will be a credit here. 210123. Okay, and then merchandise inventory for kitchen 1470862. Merchandise inventory for bath, again I'm pulling this from the ledger, 97,671,31. Supplies, 1950. Prepaid insurance, 2,500. Okay, accumulated depreciation, office equipment. Okay, again, looking at the balance, 18,674. And accumulated depreciation store, 36,255. Federal income tax payable. We haven't done income tax because we have to wait till we do all this other stuff first. We have to kind of come back to income tax. Okay, so we're going to skip down here to income summary for kitchen, 6194. 62. And bath is 94869. Depreciation expense, all the expenses now. Okay, so 7250, 8490 for depreciation expense store, insurance expense 15500, supplies expense 414789, uncollectible account expense 202385. Okay. And then we'll actually put in federal income tax expense. We just haven't figured that out just yet. Okay, so I'm going to come back over here because I want to write, and just to give you a reminder that these numbers are from the new ledger balances. Okay, after adjusting entries. All right. So we have posted, we've entered on the adjusting trial balance. Now it says calculate federal income tax using the tax table, and then prepare the posting, the entries, and complete the adjusted trial balance. So this is kind of a tedious part, all right, because what we need to do is we've got to look at our income statement accounts. Okay, so from this point down, let me get this out of the way for a second. Okay, these are our, from this point down, okay, all the way down here, these are income statement accounts. Okay, and so basically our credits minus our debits gives us our net income. All right, so income statement, whoops, got a hole in the paper. income statement, credit minus debit equals net income before taxes. Okay, that's net income before taxes. All right, so once we find our net income before taxes, then we put it into the tax table, find out what our taxes are, put that back in here, and then recalculate to find what our net income after taxes would be. Okay, so what we have to do is we have to go starting here, add up all of the debit column, add up all of the credit column, and subtract those. Credit minus debit equals net income before taxes. Okay? So, again, for working together purposes and video purposes, I'm going to give you those numbers. 756, 246, 40. Okay? And 678, 307, 71. All right, so this is the credit column added up. This is the debit column added up. The difference between those two is net income before taxes. So this minus this equals, I don't know, can I do it this way? Will that make sense? 7,793,869. 69. So that's our net income. That's what we have to pay taxes on. All right. Then we have to use the tax schedule. All right, and that's going to be in the book. So we want to plug this number in. And our working together gives us that information, or gives us a little grid to help calculate it. Okay, and then you want to be on in your book on page 104. Okay, so this is the tax schedule that they're showing us in this book. All right, so for any net income between 0 and 50,000, we're going to have to pay 15% tax. Okay, for 50,000 to 75,000, the first 50,000 basically is 7,500. Okay, that's 15% of 50,000. Okay, then between 50 and 75,000, that portion, that 25,000 gets taxed at 25%, and then this 25,000 gets taxed at 34%. So our entire net income doesn't get taxed at the same level. The first part of it gets taxed lower, and then the higher it goes, the percentages go up. Okay, so what this does is it breaks it down. 75 to 100,000 gets taxed. That 25,000 gets taxed at 34%. But the 75,000 before that gets broken down into two other tax brackets. They're figuring that out for you already. Okay, the tax on 75,000 is 13,750. Okay, that's where that number comes from. I hope that makes sense. If not, ask me and I'll try to explain it another way. Okay, and it takes you through a picture here. So this is basically what we're doing in our working together. Okay. All right, so net income before taxes. I gave you that number. Um, 7,793,869. Okay, and that tax bracket minimum, where we are, so we're 77,000. So we're in this group right here. Okay, so we're going to subtract 75,000 from that number. Okay, so we can figure out the 34%. What's being taxed at 34%? How much is being taxed at 34%? The other we know is already being taxed at 13,750. Okay. So minus the 75,000. Okay, so this number is the credit minus the debit. This number comes from the tax schedule. Okay, and then we do the math. So that math is 2938.69. This amount right here gets taxed at that 34%. Okay, so this number comes down here. Okay, this comes from the tax schedule. All right, so 34% of 2938.69 is 999.15. Okay, marginal tax income tax, marginal income tax. So that number's coming right here, 99915, and this again comes from the tax schedule. This is that 13750. Right there, 13750, and 34% of whatever piece. Okay, here's the 34% of our piece plus 13750. So our full income tax bill is $14,749.15. Okay. All right. Now, that's important. We need to know that. Okay, that's the expense for the entire year. But, and we've already paid some of our taxes. We've been paying those as we go. So going back to our ledgers, I just gotta find the right page. Okay. Right here. If you look at the federal income tax account, you can see that we've already paid $12,000. Companies don't want to pay it all at one time. They usually pay it quarterly. So throughout the quarters, we've paid $12,000 already. Okay, this now is what we still owe. So minus the $12,000 means that we still owe $2,749.15. Okay, still owe right here. This was already paid. See ledger. This is all kind of backwards, sorry. Okay, we already paid this because we can see it in our ledger. So this is how much we still owe. So this is still payable. Okay, so we're going to record this in payable, and we're going to add to the income tax expense that we've been accumulating already. Okay, so this number right here is actually what the adjustment is going to be. Okay, this is what we still owe, and this we need to adjust, make an adjustment for. Okay, so that's the number we need to finish up here. So still on the 31st, federal income tax expense for $2,749.15, and federal income tax payable $2,749.15. Okay. All right. So we had to calculate this right here on number 4. That's where that one came from. Okay. And now this is net income. Oh yeah, so that's good. We'll come back to that one in a second. Okay. Now we will post that. Okay, and you can see that when we post the 2,749, now it brings us back up to the 14,749, which is the total amount of tax that we are paying. Okay, And then federal income tax payable. Okay, again, 274,915. Right? Then we can go back to our adjusted trial balance and finish those two. So income tax payable right here, 274,915. Okay, and the expense, again, these are the ledger balances, right? Because you've journalized and posted those adjustments. 74915. Okay, now we can really get our final total. Okay, so now we'll do totals. Calculate those totals. Again, I'm going to give them to you. 1,095,911.24. 1,095,911.24. Okay, debits equal credits. It's all good. Now, I am going to tell you that as soon as we hit millions, our little 10-digit calculators won't work. What's going to happen is that if you try to use that calculator and you're in the millions, that 4 is going to get cut off and it'll look like 20 cents, and then all your cents will be off. Okay, so as soon as we start getting into these million numbers, you're going to have to switch to like your graphing calculator, your math calculator, and I have a few of those if you need to borrow one. Okay, all right, so let me look just to make sure that we did everything. We calculated federal income tax, we posted it, and we completed the adjusting trial balance. Okay, so that takes care of 4.1, taking care of the adjustments, journalizing them, posting them, transferring them to the adjusted trial balance, or the trial balance, the adjusted trial balance because it's after all the adjustments, figuring out the tax, okay, and finishing that adjustment out as well. And I will tell you that at some point you will need the net income after taxes. Okay, so remember these totals right here, this is everything, right? Balance sheet accounts as well as income statement accounts, okay? And I think at some point you're going to need the net income after taxes, so you'll have to come again to this point and add up credit minus debit to get the net income after tax, okay? And then I guess also we can go back to our notes page and finish this little page out. Okay, net income before taxes. Okay, these were the balances I believe that I gave you. 7. Okay, so net income before taxes 7,793,869. All right, and then we take that number minus the 75,000. This is just like that worksheet, really. 2,938.69 times 34%, which comes from the tax schedule. Gives us 99915 plus the 13,750, which comes from the tax schedule, gives us 14,749 for the year of taxes. Okay. Now, we need to look at, this is what I'm talking about, we've already made some payments, find out the amount that we still owe. So 14,749 minus 12,000, which came from the ledger. We've already paid that. 274915 is what we still owe. Okay, so that's now a payable until we pay it, and it's an expense, adding it to our expense for federal income tax. Okay, now that should finish that up. That way your notes page is complete as well. All right, there you go.